Recently, two Federal Reserve researchers wrote a paper in which they concluded that quantitative easing was making the economic, financial, monetary system more fragile by pulling collateral out of the system, US Treasuries. Well, two other Federal Reserve researchers have come to another surprising conclusion, and I'm going to talk to Jeff Snyder, the head of global research for Alhambra Partners, about this new, very interesting conclusion that was brought to our attention by a reader, a watcher, a listener. So thank you very much. Jeff, we're going to start out by discussing the interest rate fallacy before we get to the punchline. Can you tell us what the interest rate fallacy is?
Well, I think the interest rate fallacy kind of connects everything together. Not only does it tell you what's happening, it tells you why things are happening. And very simply, as Milton Friedman put it in 1967, and I think you even, Emil, even you had it uncovered an earlier quote from, was it 1964, where he referenced the interest rate fallacy. But, you know, basically what he was saying is that we have interest rates all backwards. And by we mean the financial community and academic economists, central bankers, all those kinds of people. What we're taught to believe is that low rates equal stimulus, that monetary policy is being accommodative and loose and all of these things. And it sounds very intuitive that that would be the case, right? Because low interest rates means it's cheaper for borrowers to borrow. Therefore, they'd be lining up at the local bank to borrow money, which would, you know, create positive economic impacts and all those, you know, inflationary stuff and all that kind of stuff, all that kind of thing. So, you know, low rates are stimulus, and consequently, on the other side, high rates are restrictions. That's slowing the economy down, making borrowing more expensive so that less borrowing takes place. That's what we're taught. I mean, first day you sit down in Economics 101, that's what they're going to tell you. The Federal Reserve controls interest rates, number one. And number two, the way it controls interest rates, or the reason it controls interest rates, is low rates are stimulus, high rates are a brake on economic growth, especially inflationary economic growth. What Friedman says is, nah. Historical experience has shown conclusively that that's exactly backwards. When we see low interest rates, money must have been tight, like the 1930s, the Great Depressions, as we've talked about many times before. If you go back to the 1930s, which no one in their right mind would ever equate to a period of loose monetary policy or conditions in the banking system, interest rates were low. And as you know, after he made the interest rate fallacy speech in 1967, we then were moving into the great inflation, where money was so loose it created enormous global problems. And what were interest rates doing in the 1970s? They weren't low, they were high. So Milton Friedman was absolutely correct in pointing out that we have interest rates backwards. And by we, I mean, again, the financial community and especially central bankers.
For anyone in our audience who would like to read Milton Friedman verbatim, referencing what we just discussed, you can do so at the end of Jeff's essay, which was posted at Real Clear Markets, and it's titled Slight But Only Slight Movement in the Understanding of Rates. Now it's posted on April 9th. And seeing as it's April 9th and me being in a British overseas territory in the Cayman Islands, I have to, of course, acknowledge the passing of Prince Philip and condolences to our UK audience and everyone in the overseas Commonwealth family. So a sad day. But Jeff, let me move on back to the article with respect to an event in February of 2005. Greenspan made a speech to Congress, and then a month later, Ben Bernanke, in March, he made his own speech. And in that speech, well, I guess I don't even want to go too far. Tell us first, what did Greenspan bring to our attention? And then what did Bernanke try to explain a month later?
Well, remember, in the textbook conception, there's two parts of this supposed setup, this monetary policy regime. The first part is the Fed controls interest rates. The second part is that low interest rates are stimulus and high rates are constriction. So there's two parts here. And Greenspan in February of 2005 was talking about the first part. What he was saying was that, look, the Federal Reserve, starting in June 2004, began raising interest rates. And what he expected, and what pretty much everyone expected, Bill Groves, all the bond kings, everybody had talked about at that time, was, gee, long-term Treasury yields aren't rising. And what he said before Congress was, look, when we think about Treasury yields, we think about the bond market, we look at interest rates as a series of one-year forwards. In other words, you stack them one on top of another. Therefore, if the Fed controls the first in that series, the rest of the series should just fall in line. So if the Fed is raising rates at the short end, you would expect that the long end would rise by the almost equivalent amount based on, considering a couple other factors. But by and large, the Fed raises rates 5, 6, whatever times up until that point. They would expect the equivalent of that short end increase in interest rates to be traded in the long end of the market. In fact, that never happened. And so in February of 2005, Greenspan's before Congress saying, this is a conundrum. We control interest rates. We tell everybody we control interest rates. It's a series of one-year forwards, yet here we are in this rate hike regime and the long-term Treasury yields haven't even moved. And I think by that point, they were actually a little bit lower. So the bond market was saying, you think you control interest rates, but you really don't. So that was that's the first part of it. That's an important part. The Fed believes, in theory, even to this day, that interest rates do not act independently. And so that was really his conundrum, was the long end of the yield curve is acting independently. That's not something we believe.
Let's tease that out very quickly. What do you mean by they do not act independently? They believe literally that they control both the short and the back end of the curve. Is that right? They are dependent on the central bank, with some accounting for perhaps time differences and things like that. But it's
the series of one-year forwards proposes that the Fed, you don't want to say control, and they probably wouldn't, but they would say heavily influences interest rates, so that monetary policy conducted at the short end would immediately transfer to the long end with some leeway and margin for error and things like that. And it's the same fallacy that the Federal Reserve also assumed by controlling only the federal funds rate, and then assuming that any rate hikes or any transmission would immediately go into LIBOR and the Eurodollar rates too, right? Because LIBOR, previous to 2007, had traded almost exactly like federal funds had up until that point. So there's this whole assumption that seemed to be backed by some experience that said interest rates all over the place do not act independently of monetary policy. And so if you're a central banker, you're thinking, I only need to control one little tiny sliver of the marketplace, and then I influence everything else in exactly the textbook fashion. That's the hubris, the arrogance that I don't even need to understand how the marketplace works. I just move the federal funds rate around, and everything else in the economy falls in line. That's what he means when he says rates are not independent. And this is something that he talked about earlier in June of 2003 during an FOMC meeting, when they talked about why Japan was failing at QE. They were starting to wonder, our rates may be independent? And Greenspan said, no, we can't even go down that road, because it kind of it destroys pretty much everything we believe. So when 2005, he's in front of Congress. Yeah, we're raising rates, but the long end of the yield curve is seemingly acting independent. That was a watershed for all the wrong reasons, because it showed maybe the Fed doesn't operate the way we all think it does. And then you start thinking, well, why isn't the Fed the center of the universe as it proposes? And that's where we get into Bernanke's speech in the Global Savings Glut.
It's a stunning geocentric view of the monetary order. Amazing. They really believe they are in charge at the center of it. It's incredible. Chutzpah. And as you said, arrogance. So a month later, Ben Bernanke heads to Virginia, to Richmond, to an economic conference, an association of economists, the Virginia Association of Economists, and he explains the conundrum somewhat, and he identifies why risk-free rates are acting consistently, and there's a housing bubble as well, maybe, and he points to foreigners.
Right. We have to have a reason why the long-term bond yields are are acting independently or seemingly so, because a couple of things that we noticed in the middle of 2000s, apart from that whole housing thing, which remember Bernanke said, that's no big deal. Remember, if you recall, and even today, the Federal Reserve's position on asset bubbles is that we don't know an asset bubble is an asset bubble until after it happens, and markets can get frothy, and so we don't really pay attention to what are obvious asset bubbles. However,
that's just the Fed's view, right?
That's the Fed's view,
because the Bank for International Settlements.
Too.
Well, what do you think of the Bank for International Settlements? They've come up with, I don't know, half a dozen, 5 or so of early warning indicators based on various financial measures, including property prices, that say when these things go well above normal to the national trend, that's an early warning indicator, about a 50% chance of a financial crisis in the next 3 years. That sounds like they're saying, hey, we can identify asset bubbles ahead of time. Is the Fed just...
Not that I'm arguing Bernanke's position. I don't believe it. But what he would say is that, yes, that's possibly true. And by the way, the Fed also, they talk about during those years too, about how housing factors, whatever prices, activities, building, all the stuff that goes into the housing market, they knew it was above normal. It's not that they didn't know that it was outside of historical experience. They knew it was. But what their position is, again, this is not my position, but this is what Bernanke would tell you, is that we have to understand that there might be reasons why that is the case. The fact that it's outside of historical experience doesn't necessarily mean it's a bubble or it's harmful or something. There might be some reason for it. And that's, again, one of the motivations for why he came up with the Global Savings Glut, because in his view, that was all part of the problem. From what the Federal Reserve was observing, not just in the housing market, but more importantly in global trade in the current account, the US dollar's exchange value falling, what it looked like and of course, foreigners buying US Treasuries, what it looked like for Ben Bernanke and Alan Greenspan's perspective was that there was all this flood of money coming onshore into the United States. And of course, the Federal Reserve long ago saying the Eurodollar system is nothing more than a weird little investment scheme of the banks. It's not really a monetary system. If you see a flood of US dollars coming into the United States and you don't believe there's a dollar system outside creating them, what is your answer to that? And what Bernanke came up with is, well, it must be foreign savers. Foreign savers are converting into dollars and buying US dollar assets because baby boomers are getting ready for their retirement and they prefer US dollar assets for some reasons that he really never really explained. But the point is, he's trying to connect all of these dots, including, as you just mentioned, Emil, about, hey, housing is outside of its historical norms. How can we account for that? US Treasury yields are not obeying their series of one-year forwards. How can we account for that? The US current account is deteriorating way outside of its historical norm. The US dollar is falling. How can we account for all these things? And what he said was, it sure looks like a global savings glut because there's all this, it looks like a flood, but it can't be money, it can't be dollars. Otherwise, people might blame us. So it's got to be foreign savers.
And you point out here then, well, perhaps there is a contradiction with the assumed notion that the central bank is at the center of the monetary system and that they control the rates. And then there's this foreign outside savings glut force that's influencing rates and the dollar in the current account. So that was unsettling, you said. Here, I'll read it out. If foreign savers could achieve such an unshakable grip over the very basics of risk-free rates outside the very short run, then surely the allegedly omnipresent central bank could not have been living up to its own lore.
If you accepted Bernanke's premise that foreign savers were so heavily influencing risk-free treasury rates at the long end, you also had to give up on Alan Greenspan's series of one-year forwards. Those two things were mutually exclusive. And so as Bernanke tried to account for what was going on in the middle 2000s, he definitely realized, I got to at least admit one part of our myth is broken here, that rates are acting independently. I'm going to blame foreign savers for that, but either way, you can't have both. You can't have the Fed control over interest rates and keep the whole thing going. Of course, all he was really doing was trying to reconcile his worldview to what was really going on, because what was really going on violated his worldview in any number of ways.
Well, recently, there are two researchers out of the Chicago Fed decided to take on this global savings glut thesis. Now that I don't know, 15 years or so has passed. Here, let me read what where people can find it. Again, Federal Reserve Bank of Chicago, and the title is "The Global Saving Glut and the Fall in U.S. Real Interest Rates: A 15-Year Retrospective." It's by Robert Barsky and Matthew Eason. Let me read a quote that you brought out here in your article. Quote, "First, falling long-term real interest rates were considered a major source of the housing boom that eventually gave way to the global financial crisis of 2007-08. Second, long-term rates stubbornly continued to fall during the expansion following the 2001 recession, despite a sequence of increases in the federal funds rate and associated short-term market rates, a phenomenon that became known as the Greenspan Conundrum." You know, the part that I circled here that kind of stood out as kind of awkward is that falling long-term real rates were considered a major source of the housing boom. The way I always thought of it was that there's just a lot of money everywhere. The Eurodollar system was throwing off money, and therefore that's what led to the housing boom and asset bubble with money everywhere. Not so much that interest rates led the way.
Yeah, but that's, again, Bernanke's position, the traditional mainstream economic position is that interest rates are that powerful. And it goes back to, the monetary evolution, even the early Eurodollar system, where much of what economics thinks about in terms of how things work, they think about everything in terms of interest rates nowadays rather than quantity of money, because they don't know the quantity of money. They certainly can't define it and they can't measure it. So they have to reduce their conception of how things work into something. And since the 70s, that's been interest rates. Interest rates go up. They think backwards. That's a bad sign. That's constriction. Interest rates go down. That must mean it's cheaper for borrowers. Therefore, there's your bubble. Interest rates are too low, and that's where the bubble came from.
Let me read another quote from them. And dear audience, hold on, okay? After I read this quote, Jeff will explain it to us, okay? But let me read it anyhow. "We observed that the decline in the absolute value of current accounts paralleled the reduction in gross trade flows occasioned by the Great Recession. Consequently, we concluded that the ability of the global savings glut hypothesis to explain the fall in long-term real rates between 2002 and 2006 is probably significantly greater than its ability to account for the further fall in rates from the Great Recession onward." What does that mean, Jeff?
What they're saying is that it looked like the global savings glut hypothesis was somewhat probable before 2007. And the reason was because the things that Bernanke was talking about and writing about, this flood of money onto the United States shores, all that was evident in the data. And that's the reason he came up with the global savings glut hypothesis to begin with, was because it looked like all this money was coming into the U.S. The U.S. was borrowing money from outside the U.S. The U.S. was borrowing savings, in his view, from outside the United States. And what they say is that, well, once the Great Recession hit, all of a sudden the U.S. current account and the offsetting current account surpluses for much of the rest of the world disappeared. So there was no more money coming into the United States. So if Bernanke was right that foreign money coming into the U.S. buying Treasury was the reason that Treasury yields fell more than they should have, or were lower than they should have been in the pre-crisis era, there's no way to account for it after the Great Recession, because there is no global savings glut anymore. That's really what the conclusion is.
Well, the Council on Foreign Relations or at least it just came to my attention, they put out this global imbalances index that I've pulled up. And I think we can see what we're talking about here. On top is the current account surplus for all the different countries. And they break it down by China, East Asia, Eurozone, other Europe, and then other regions, as well as Anglophone countries. And then below the zero line are all the deficits. And you'll notice that the biggest chunk on the deficit is the Anglophone countries. And of course, that's referring to Australia, Canada, New Zealand, the United Kingdom, and the United States. And we can see how that's expanding. It's expanding as we head towards 2008. Let's see, from 1998 to 2001, it really surged, right? It was seemingly somewhat stable for the Anglophone countries. And then it surged and it took a little break. And then from 2002 to 2006, again, a huge surge. And it seemed like East Asia was leading the way in that particular era before the financial crisis when it comes to, I don't know, what would you say, the surplus countries from 2002.
Yeah, and the paper that we're referencing, the Chicago Fed study, they also make the same observation, which is that the surplus was mostly in Asia. So when they statistically decided to test the global savings glut hypothesis, they broke up the world in basically two categories. There was Asia, and then there's everybody else. Asia was the savers. And they include in Asia also those in the Middle East and sort of, I think, some North African countries, some of the oil producing countries too.
Yeah.
So the idea was that in the global savings glut hypothesis, as it went through sort of iterations, was that the savers were in Asia and they were investing their savings in US Treasuries primarily, but not just US Treasuries, but other US assets, which, we've talked about before using tick data, for example. You can see the same exact thing. This is something that is observable across many different data series. So it's one of those things that you have to account for in some way. But does the global savings glut hypothesis stand up beyond 2006 to 2007? As you're showing here, it can't. Because even in this data or the tick data or any number of other data series, what you see is that there is no global savings glut, which, I mean, in our view, there was never a global savings glut. That was wrong to begin with. But as far as explaining lower treasury yields from a flood of savings coming into the United States, it was somewhat plausible 2004, 2005, 2006. But then you get into the post, 2007, 2008 and beyond, it's not at all possible. And by the way, during that period, obviously, since 2008 forward, U.S. Treasury yields have fallen even further. And that's really what they're saying here is that, look, we can't account for this this post-crisis decline in yields, according to the global savings glut, because there was no global savings glut at that time.
What about this quote here? They say the role of weak investment worldwide appears to tie in well with the secular stagnation hypothesis, a close but brasher cousin of the GSG hypothesis.
Now we're getting closer to the interest rate fallacy being recognized in the official literature, which is that low interest rates are since we can't look at the global savings glut as causing low interest rates, we have to recognize that they do correlate with other outcomes, including weak investment, as Larry Summers has proposed in the secular stagnation hypothesis, which is finally getting interest rates into the correct context, which is that low interest rates seem to correspond and correlate with bad and undesirable outcomes, and we can't explain it this time with a global savings glut. So it's more of, okay, it wasn't really the global savings glut, it probably wasn't before the crisis. How can we account for it? All we know is that lower interest rates, weaker investment, secular stagnation, these things seem to go together. But when we wrap all of these things up in the actual data, the current account, what's going on with these monetary flows inside and outside the United States, that's where you depart from the global savings glut and get into global US dollar, euro dollars, that kind of thing.
You say it had never been savings. These weren't Middle Eastern or Chinese baby boomers getting ahead of their old age needs. It had been just a domestic spillover from the vast external banking architecture going nuclear from the mid-90s to the mid-2000s. So you're saying the Eurodollar system was creating this surplus surefit of money. It couldn't it satisfied all the internal advanced economy money center investment needs. It flew out to the emerging markets, saturated them. They then sent it back to the advanced economy money centers.
Yeah, some of it was redirected. I mean, look, a lot of it was redirected in foreign official accounts, right? Because China, perfect example. Eurodollar is throwing dollars into China, massive quantities of dollars, which the PBOC, to try to manage their currency regime, picks up and vacuums up a lot of those dollars and buys US Treasuries with it. So as all those dollars are moving into emerging markets in Asia, some of them are being reflected back inside the United States. That is what Bernanke saw as a global savings glut. He saw the Eurodollar's expansion being boomeranging or reflecting back into the US and said, well, I don't believe in a Eurodollar. I'm not allowed to. So it must be global savings. It must be the Chinese are saving, when in fact it was nothing more than the spillover of monetary expansion offshore. That's how we can account for the difference. What looked like a global savings glut was a massive spillover before the 2008 crisis. The global savings glut didn't disappear because it didn't exist. It was that there was no longer this flood of dollars worldwide. And so without the flood of dollars, there was less dollars being redirected back into the United States. The current accounts all adjusted to that fact. And that's why interest rates kept going lower, because now we moved into a monetary shortage situation.
And see, but you say that also explains Greenspan's conundrum. So yeah, after 2008,
I think that's probably one of the more confusing aspects of this, because we're saying lower interest rates mean tight money. But during Greenspan's conundrum, that could not have been the case, right? Whether you believe in global savings glut or believe in the Eurodollar, middle 2000s was when, as I said before, that's when the Eurodollar system was going nuclear. That's when money was available everywhere around the world. So how can we say lower interest rates and tight money? Well, the answer is that risk, perception of risk, reality of risk, it wasn't tight money at that time. The market was preparing for tight money in the future. In fact, in the near future. And so the banking system in particular, not just foreign central banks, but also global banks, were buying US Treasuries, stockpiling safe assets, anticipating, first of all, for collateral reasons, but also anticipating that we think there's a housing problem here, and not just a housing problem, but there was a corporate debt bubble across the rest of the world. If this starts to go wrong, it could get really bad. And so interest rates were falling in the middle, the bond safety yields were falling in the middle 2000s as things were going manic and excessive, anticipating what actually happened. The tight money that did show up starting in, I would argue, 2006. So It wasn't really that far off. And it was the system adjusting, despite Alan Greenspan raising the short-term rate, saying everything's fine, longer-term rates, this flood of money was saying, this shit could all hit the fan really quickly here, pardon my language. This could go really bad really fast, and that's exactly what happened. So the low interest rates in the middle 2000s were reflecting the likelihood, probability of tight money in the future, which is, of course, exactly how it worked out. And again, it's safe liquid assets, safe liquid assets. Safe liquid assets are in demand when you think liquidity is going to be a problem.
That all makes sense to me, but it violates a couple of key assumptions of the geocentric view of the monetary order that the central bank has. But I guess the bigger picture, when we look back to the show we did 2 weeks ago about QE and how researchers said, it's only contributing a little bit to a reduction of interest rates. And then last week, our whole discussion about collateral and how two researchers from the Fed were saying, maybe this is making the system more fragile as we're pulling out collateral, forcing banks to have to reuse, rehypothecate, repledge many more times. And now another paper. So it's, what do you think, Jeff? It's positive. These
small progress, right? It's being hit over the head by 15 years of evidence that runs contrary to mainstream orthodox theory. And after enough time, at least a few people are starting to say, maybe we've got this all wrong. It's starting to, we're looking at the world and we're not seeing the things that we're supposed to be seeing. We're not seeing how low rates are corresponding with positive outcomes. We're not seeing how the Federal Reserve controls everything. Forget, long-term, what about even LIBOR and all these other things? I mean, it's starting to reconcile the way the world actually has behaved over the last couple of decades with how the textbook must be wrong about some of these most basic assumptions. Again, we started with two of them. The two of them were the Federal Reserve controls interest rates, and that it does so because low rates are stimulus and high rates are the opposite of stimulus. And those two things in particular, evidence has shown conclusively that there's really no other way to explain them that keeps the mainstream model afloat.
Well, in part two of our discussion, we're going to take a look at some interest rates, the US Treasury rates, and see what they're up to, both the short end, the near term, and the long end, because they've diverged some. So we're going to check in on that market, very important market, and see what the market is telling us about the state of the economy and the future ahead.
But first, this from Eurodollar Enterprises. Friends, are you confused by the financial press? Are the pretty people on Bloomberg speaking in paradox? Are the esteemed pages of the Economist written in contradiction? Then the new Eurodollar Enterprises Dictionary of Economics is for you. Yes, from AbeMoronics to ZIRP. Zero interesting, reasonable policies. Confidently leaf through your folio to define Yellenism, Powellution and Greenspam. Money, a noun, is defined as a blessing that is of no advantage to us, excepting when we part with it. What is a synonym for wealth? Impunity. What is the compound word for making economics erotic? Bernanke-panky. The new Eurodollar Enterprises Dictionary of Economics. New from Eurodollar Enterprises.